Hi, this is Ernie. I'm that guy who had $6 in a checking account to now having millions of dollars. Many of you are still asking, despite one of the videos that I posted, still asking, what happens if your stock or ETFs go down? So I want to talk today about risk versus reward. And there's a website called Napkin Finance. They did an amazing job of illustrating what risk versus reward actually means, and what type of investments typically have low risk, which means low reward, and which type of investment has high risk but will give you high reward as well. So let's jump into the chart that they have created. The rule of thumb is when there's high risk, then your return is going to be higher. Which conversely means if your risk is low, then your return tends to be low. So what are types of investment where risk is low and return is low? Those are savings account. Annually, they'll give you 1 to 4% depending on how much money they have. Bonds, on the other hand, can give you a little bit more. It's a little bit riskier because people still can default on their bond payments, and we have seen that a lot during financial crisis. So it is little riskier, and because of it, they are willing to give you higher return. Some bonds that I've seen goes as high as like 8%. So better return than 1% or even maybe 4% you might be able to get. And then it comes to stocks. So stocks, S&P 500 this year gave you close to 20% or maybe somewhere between 16 to 20%. But on average, S&P grows at about 9% a year. But of course, some years will go up, some years will go down. Startups will be another one. This is where a lot of companies, what we call venture capitalists, they typically invest. And if you invest in a right startup, although many startups will fail, but if you invest in a right startup, this is where you hear companies or VCs that invested $10-20 million and they pocket billions of dollars. Risky. And a lot of us will not have access to these unless they go through on our IPO. And then cryptocurrency. You've heard people buying Bitcoin when it was $1 and becoming a billionaire. But there are a lot of coins that went bankrupt as well. So extremely, extremely risky. That's why you hear of people who became instantaneous billionaire, but you don't hear that from people who diligently saved and they became a billionaire overnight. And risks, there's a volatility, there's inflation, black swan event, like internet bubble bursted, COVID, a lot of things could happen. So if your risk appetite is only here, then savings account might be the only thing that you should consider. If your risk appetite is a little bit higher, bonds, and then stocks and etc. What I've always suggested people is, if your risk appetite is here, put 90% of your money in savings, but maybe allocate 10% or 5% here and 5% there, so that you'll be able to get a sense of the type of return you're able to get. And I'm going to show you, sorry, got cut off. I'm going to show you another chart. This is, the red line is a less volatile investment, like saving. If you put it in your saving, it will go up, but slowly. Versus if you put money in stocks or crypto, there's no guarantee that it will go up. And it will fluctuate. Maybe you will buy it at this point and then it's going to tank. But that's the risk that you have to accept. Going back to the previous chart, investing always comes at a risk. Everybody hopes that stock will continue to go up as soon as or immediately after you purchase. That's not the case. It will go up, it will go down. But again, if you were to look at S&P 500, if you look at S&P 500, just like I mentioned, it will go up. But as you see, it'll come down, it'll come down, it'll come down, it'll come down. But if you hold it for a very long time, this will grow. So if you are a little worried, then individual stocks probably is not the best way to do it. Maybe the better way is either bond fund or something like this, which is S&P 500 fund. Hopefully this chart and this diagram was useful for you to make a decision on whether you want to start investing or not. But I do really recommend that you set aside a portion of money to do investment. Even for our kids, I put $100 every week into their account and put it into an ETF, and it has been steadily growing. And hopefully by the time they turn 40 or maybe 30 and ready to buy, maybe we can convert some of these accounts or liquidate them so that we can help them with a down payment for a house or pay for their college, or maybe we'll just convert everything into their retirement fund so that they don't have to never worry about retirement. But I highly recommend that you start investing rather than just putting money into your savings account. Hopefully this was helpful. And feel free to ask questions if you have any.